morning, everyone. Welcome to the Spark Festival again. We're pleased that you've taken some time out to watch a webinar today. And today we're going to be talking about accounting and R&D tax incentives. So the R&D tax incentives are definitely helping out many innovative tech companies push the frontiers of science and technology. But it's also important to recognise that there's an accounting and tax aspect to these as well. And that's what we're going to be exploring this morning. I'm here with Jack, who heads the R&D team.
Hi. Hope everyone's been having a good day, and really pleased to be part of the Spark Festival for another year.
So we've got an action-packed agenda for you today, but disclaimer, please be wary that this is general information and you'll need personalised information for your circumstances. All right, so we've got a bit of an action-packed agenda today. We're going to look at the tax cycle and R&D cycle for you. We'll be looking at how it integrates with the end-of-year planning, look at how we treat expenses for R&D versus tax, franking credits, as well as we'll be looking at tax planning and group structures there for you. The tax and accounting schedule, you can see here that it's very busy towards quarters 1 and 2. But that said, throughout the year, we're completing our BASs, and it's good to have these done regularly so that when you come into R&D time around quarter 4, when you're preparing the application, that you have all your accounts ready to go. And then after the end of quarter 4, 30th of June, that's where we start preparing and lodging an R&D tax application. This includes project descriptions, an estimate of the R&D expenditure, as well as an estimate of the refund that you might receive. We lodged the application, and hopefully within a matter of days or weeks, we received the registration number from Oz Industry. We then use that to populate the tax return, including an R&D schedule. And we file this with the tax office. Another few days or weeks, we then receive a refund after the tax return has been processed. So that's the general theme. End of year tax planning. What should we be looking at here? As I mentioned earlier, you want to have the BAS records up to date and current. If you're working with a good R&D consultant like the team here at Fullstack, you'll have much of the application already ready to go by July. There'd be plenty of companies here that might have overseas activities. And if you need to include those overseas activities or personnel, might pursue the overseas finding, which needs to be lodged before 30th of June as well. If you're paying associates like your founders, you want to make sure that these are properly taken up and paid with the cash properly transferring. There's no accounting magic that can happen after that, after the 30th of June. And we also want to make sure that the super is paid and deductible. So R&D, it does impact the franking count. And it's just important to know that it's a real situation for your tax return where profit-making companies, if you're using the tax incentive, it potentially reduces your franking credits. That is your ability to pay franked dividends at the end. For loss-making companies, the refund is just simply debited to your franking account. And this can impact balance for future situations. All right. So how do we treat some of the expenses? Normally it's just a deduction against revenues to reduce your taxable profit or increase the taxable loss. For most companies, it's just simply a 25% tax offset for most base rate entities. Or if you're basically an investment company, you'd be looking at 30%. And it's important to know that losses carry forward, they can offset future profits. Jack, did you want to jump in?
Yeah, absolutely. So one thing that we really try and make sure all our founders and clients understand is really the mechanisms behind the operation of the R&D tax incentive. So you do need to understand that when you're applying the accelerated, generally 43.5%, so 25% normal tax rate plus 18.5% uplift for R&D, that's obviously a huge benefit. And for smaller companies with grouped or aggregated turnover less than $20 million, that will be available as a refundable tax offset. However, depending on your overall tax position for the year and taking into account, prior years and carried forward losses and previous R&D returns and things like that, then at some point, hopefully when you start paying tax, the kind of calculation changes. So instead of getting the full 43.5% back as a cash refund, you would instead be paying less tax. On one side of the spectrum, it's 43.5% refundable. On the other side, it's paying 18.5% of your R&D expenditure less tax. As with some of the themes throughout today's presentation, it's just really important having that knowledge and that forward-looking aspect so you can kind of improve your planning and making sure that you're aware of cash flow implications. So in that theme, There are some kind of broad categories that we'll quickly run through today, just to think about in terms of the long-term tax planning and the R&D tax and how that all plays together. So we like to look at things in a much more holistic fashion. It's not just focusing specifically on the R&D tax, but it's looking at everything broadly, personal tax as well, potentially for founders, and making sure that we're set up for the long term. Some things to think about if you're not already: group structures. I'll go through that in more detail as to how and why that's important. The cash flow projections will be affected, as I mentioned, by those different rates in your overall profitability. Over the longer term, you might start getting those large cash refunds, but then they might drop over time as those tax losses are used, and as the company becomes more focused on profit generation, revenue generation, and profit distributions will come into that. One thing to very carefully consider is, as for founders, this is crucial: when and how to recognize salary or contractor costs for your time. One of the most common questions from our founders: when should I start paying myself? Or, I've got some money in the bank. Is now a good time to put some money into the business and start paying myself? Especially where, in the first couple of years, maybe it's a bit sweat equity and you're not actually recognizing any formal payments. One thing to consider, the main thing that I think you should generally consider, is who is putting the money in to pay the founder. So something that people sometimes will get tripped up on is, okay, I've got a bit of money, I'll put in some money to the company, pay myself. In that situation, it's potentially not tax effective because you're putting in $1 to the company, you're only getting back 43.5% as a cash refund. You're paying personal tax on that dollar. So potentially, if that dollar is available, it's better to spend that on other, hiring a contractor or something like that to take advantage of those benefits and accelerate the development. Alternatively, if you do raise capital, someone else is paying effectively, investors are putting money in, that's a much more effective time to start recognizing the value of your time through either a salary or contractor payment. And there is a little bit of nuance even between those two, where if you're a PAYG salary, there's some things you may need to make sure you do around that. Similarly, as a contractor, but how you recognize your time and what areas you can put it to, whether it's R&D and non-R&D, may be different depending if you're a salaried employee or a specific R&D contractor. So again, that long-term planning and looking at everything holistically is a way to make sure that everything is done correctly and that you're in a tax-effective situation and a cash flow effective situation. And then, of course, record keeping and documentation plays into all of these things, making sure that all of this is documented. So if ATO comes knocking on your door at some point in the future, you can say, well, at this point in time, these were the facts and everything was carefully considered and the claim was correct. So yeah, group structure is one of the main things I wanted to talk about from that previous slide. This is very important and something that often, or sometimes more than it should, goes wrong initially, where people are setting up groups and it's maybe a little bit ill-defined, or an accountant or a lawyer who's not particularly confident with R&D tax sets up a group that might not be super effective for R&D tax purposes. The main thing to consider is that the company can generally only claim activities that are conducted for that company or the claiming entity. There is an exception where it is being conducted for an associated foreign corporation, but generally you need to make sure that the owner of the ownership of the IP, the control of the activities, and the financial risk of conducting activities is all within a single entity. There are sometimes when groups are set up, and I'll provide some examples where if the IP is in one entity but the costs are in another entity, potentially you have a problem under the R&D Tax Incentive program, because those things, even though there is money being spent on developing an IP, because the IP rests in one company without any cost in it, there is no claim. And so again, good documentation and formal agreements will prevent future headaches. And there are a range of things to consider. The ESIC, early stage innovation company concessions, especially, somewhat similar to the R&D tax in terms of group structures and what works and what doesn't. So just some very simple group structures to consider. So the first one, there's a head company, a holding company that holds the shares. They have an operating entity below that does the work, that owns the IP. Very simple initial kind of structure. That's fine. as long as the IP is owned by the operating entity and the money is being spent by that operating entity. Slightly more complicated is example 2, where the IP is held along in the same company in the holding entity where those shares are held as well. So that is a method to protect that IP from if the operating entity gets into financial stress, legal trouble, then group structure such as 2 may be able to protect that IP. Now, something that's really important here is if you want to claim R&D, then the R&D claim should be in the head company, basically the inverse of that first example. In this instance, you should make sure that the operating entity invoices the head entity and the head entity pays for the work being done. The third example here is starting to get a little bit more complicated, but similar principle to number 2 is where there are 2 subsidiaries. There's an IP entity and an operating entity. So again, just making sure that the costs are being borne by the IP entity. So the IP entity has a contract with the operating entity. The operating entity invoices the IP entity for the work being done, and the IP entity pays for that work being done. And then in example 4, we have the same as 3, or similar to 3, but a consolidated group for tax purposes. So that does simplify things somewhat in terms of there is an ability to move, because the head company is claiming on behalf of the other entities. From a tax perspective, they're seen as a single entity. So it makes things a little bit simpler. Similar principles apply for the early stage innovation company concessions, as I mentioned. There are kind of multiple grants and incentives at play here that may be affected. Sometimes this is difficult to unwind if it's set up incorrectly. So again, just making sure we're being much more forward-looking rather than reactive. So I just wanted then to run through a quick example to illustrate the net benefit of claiming R&D. So I mentioned rates. So there's the 43.5% refundable tax offset for most companies. That is 25% company tax rate plus 18.5% premium for conducting R&D. And depending on the overall financial position of the company at the end of the year, can greatly affect how that offset is actually received. So in these 3 examples, there's scenario 1 is where the company is making a loss greater than the R&D expenses for the year. Scenario 2 is where the company is break even. And scenario 3 is where the company is making profit. So the only thing that changes in those scenarios is just the income. And then that obviously leads to a change in the profit or loss. Now, because of how the R&D tax incentive works, because of the mechanism, the accounting add back or the add back of R&D expenses, that temporarily alters the financial position of the company within the tax return. And even though the R&D tax offset is always $43,500, how that is received will differ between those 3 scenarios. So scenario 1, where the loss is greater than the R&D expenses for the year, you get back the full 43.5% as a cash refund. In doing so, you use up $100,000 of losses, but you do carry forward that remaining $100,000. Scenario 2, because of that accounting add back within the tax return, there is a point where you are temporarily effectively owing tax. Then the offset is applied, and then the remaining amount is a cash refund of $18,500. And so you notice that $18,500 is 18.5% of your R&D expenses. So that is what we commonly refer to as the net benefit. So you always get, if you're on a 43.5% refundable tax offset, the offset is always 43.5%. That is the benefit. It includes a timing benefit of being able to cash out your losses and a net benefit in terms of the R&D premium. In scenario 3, there is no ability to obtain the offset as cash in the bank as a refund. Instead, the tax offset reduces the amount of tax payable. So if you follow that calculation through, you'll see the reduction in tax payable is $18,500, which again is that permanent benefit, that overall net benefit of claiming the R&D. And then so over time, assuming that at some point you start paying tax, then you will, after all your losses are extinguished, your overall net benefit for claiming the R&D tax will be 18.5%. I won't go through in great detail these further examples. So this is just illustrating a 5-year cycle of, you'll notice there's R&D being claimed. So that's without the R&D claim. In year 5, you're profitable, you start paying tax because you use up all your losses. But with an R&D claim, you're able to bring forward or cash out your losses. So you're being able to obtain a timing benefit of claiming the R&D. And then eventually in year 5, if you follow that example through, there are no losses to use. So the benefit will now be obtained as a reduction in tax payable. And then the third example is the same as the second example, those multi-year examples, but with reinvesting the cash refund, the refundable portion of the R&D tax offset, reinvesting that back into R&D. So you can see that the total benefit there is quite significant. Good question. So the minimum spend for R&D tax is $20,000 in notional deductions. So generally it is $20,000. There is a category of expenditure that has no minimum if you're engaging a research service provider. So for example, university or CSI or some research institution, there is no lower limit there, but generally it's $20,000. At the end of the process, the final kind of piece of the puzzle after the application form is lodged and registered is the R&D tax schedule. So this is included in the company tax return by your tax accountant, and that's how the benefit flows through. So we advocate that your R&D tax consultant be the one preparing the schedule. There are some people out there that don't like to do that for whatever reason, but it is very important to align the technical and the financial sides of the claim to make sure that you're compliant with all the requirements and that there's no kind of mismatch there. There are some common errors, and we do see where people sometimes prepare their own schedule. There are frequently errors, so it's very important that you get someone that's very experienced with the R&D tax incentive to assist you with this. There are, clawback, feedstock, treatments of depreciation, non-deductibility of super. There are a whole range of things that aren't immediately obvious to people that don't deal with this kind of work day in, day out. And one thing, and we often will have, if you're in our kind of social media channels and things like that, you'll see that we at least once a year have a specific webinar around documentation and record keeping. That is so important and something that is much easier to keep on top of as you're doing the work, as you're spending the money, rather than just a once a year. Talking to your R&D consultant once a year at the end of the year. Documentation and record keeping is a huge focus for the ATO and the Department of Industry and Science currently. I mean, it is always, but especially in the last 12 months or so, we've seen a big focus on certain things from them. So making sure that you're keeping timesheets if you're allocating labour. So there was a question around claiming your time and hourly rated cost. So yeah, you can claim time for employees, contractors, etc. You have to make sure, especially if you're a founder, make sure that those amounts are all paid. So there are the provisions, the payments to associates provisions that dictate you can only claim those amounts, payments to associates, where those amounts are paid. So you can only claim those in the year that they were paid. If they're unpaid, if they're on a loan account, you have to carry them forward until the year that they're paid. And to be able to reliably claim those, we would highly recommend that you keep some kind of time tracking, ideally timesheets, daily or weekly timesheets with some level of granularity and some level of notes in there that are able to tie your time to a specific registered activity. That will save a lot of headache in the long run if you are audited or reviewed. One thing I didn't mention, I probably should always, is just the program is self-assessment in the first instance. So it's important for you as the taxpayer to make sure that you're claiming correctly. Most claims go through all these steps without serious scrutiny from the ATO or Department of Industry and Science. Most compliance work would come after you've made a claim, after you've received money, after you've spent that money. And if at that point you don't have timesheets and you claimed a bunch of time, then there could be a situation where you would have to pay back those funds previously received. Generally, you can claim anything that is deductible under the ordinary provisions, ordinary tax provisions. There are some things you can't claim, like cost of patenting, for example, or things like that. If you are claiming time, it does need to be paid. There is no... Because sweat equity, because there's no deduction, normal deduction for sweat equity, there is no R&D deduction. And then one thing just to finally touch on is this kind of forward planning that we're always harping on about. R&D finance is a great tool if you're aware of it and you're doing those, making sure that you're on top of your obligations and keeping track of everything. R&D finance is a way that you can effectively receive a loan based on a future R&D tax refund. important that is refundable, so that's why all that planning is very important. Essentially, as I said, it's a loan against the future R&D claim received, and it will. It's a pretty good way to bring forward expenditure. So I've spent $100,000 year to date. I get back, I get a finance of $30,000, and then if I reinvest that in the R&D, then my claim at the end of the year will be larger than it would have been without that finance product. There are obviously some costs and some things that you need to do to obtain those, but that is a way with that forward planning that you can accelerate your development and get to market sooner. And then, just finally, probably covered a lot of this, just reiterating what we've already said, but having a specialist tech accountant such as Fullstack can improve those claims. We always advocate for more forward-looking, more holistic tax accounting, bookkeeping, etc., R&D tax. And so there are many reasons why we would advocate that that's all done by someone that's very familiar with the tech space, that has that strong knowledge of the program and that forward-looking and holistic view. If you do have any other specific questions, you can always get in touch with us through our website. We have booking links. It's very easy to book meetings with us. We're very happy to chat. And there's an email there as well, team@fullstack.com.au. So Fullstack, we're a chartered accounting firm. So we do all your regular tax, bookkeeping, accounting, VCFO services, etc. And then we have an R&D team led by me. Stuart is our CEO. If you do have any other questions around broader tax or accounting, then he's the man to go to.
I see Victor had a question as well. Yes, you can use this. You can use the R&D service in addition to your regular accountant if you wish. Yeah, appreciate it, guys. Hopefully we'll hear from you soon and enjoy the rest of this festival. All right. Thank you, everyone.
Thanks. Bye.